Hello and welcome to the very first episode of Money Matters with Mohit. I'm Mohit Talwar, a CIO with InvesTek, and I'm here to cut through the noise and tell you exactly what is happening with your money. So let us get started. Uh, so as far as the current market condition is concerned, I will just divide it into five parts to make you understand in a more simpler way. First of all, what is happening in the past week or the past few months? The first point is, of course, U.S. and Iran and commodity prices going off the roof with the conflict between U.S. and Iran. So, I mean, that was one of the things which market did not anticipate it, preempted, way back in December and January. And of course, we went through this entire situation, which took off the commodity prices off the roof. And I think we saw a scenario where inflationary pressures were quite high. The overall earnings of the corporate were deteriorated because of the demand reduction across various conditions. I think that was something which was a major deterrent across the industries in terms of inflation, in terms of earning visibility, in terms of the overall conditions of the market, which were not conducive as far as the growth economy is concerned. Foreign investors were selling at the same time because of the AI story, and which is happening in the West, including some of the Asian markets across Japan, across Taiwan and Korea. Uh, However, we were still seeing a good amount of liquidity conditions which were driving the financial markets, which means that at a one point where retail investors were, at one point where the foreign investors were selling the market, there was another point where the retail investors were buying the market, which is to say that the SIPs and mutual funds were, of course, the net buyers in the market. So I think that kept the liquidity conditions quite conducive. As far as the market valuations are concerned, we are still looking at a price to earning multiple of Nifty PE of about 22, 23, which still were looking quite hefty as compared to the global peers, where some of the other markets, Asian markets, are trading at 15, 16, 14 price to earning multiple. So valuations were slightly stretched. However, they were lower than long term average of 23, 24. But I think this is what is the overall market conditions in terms of what was going on at the present. So let us understand what is the future outlook. So again, I will give you 5 points as far as the future outlook is concerned. The very first point is, of course, the GDP numbers, which are looking very promising. We have, last year closed our GDP of about 7.8, full year GDP of 7.8, and in future we are actually looking at a GDP of 6.7 to 7%, which is, by the way, one of the strongest and one of the fastest growing large economies across the globe. That is point number one. Point number two is the bond yields. As far as the liquidity conditions are concerned, post government interventions within FCNR window and some of the NRE deposits, which we are looking forward from NR clients, as far as our NR deposit window is concerned. We are looking at a very strong inflow of liquidity in India. At the same time, retail investors are still participating across various funds and through SIPs, through mutual funds. I think that is giving a very strong liquidity. There is a lot of liquidity sitting across in cash within the fund, within the institution investors, which is again a very good sign of the liquidity conditions. Commodity prices have eased quite a bit, so I think that is something which is a significant growth as far as the looking at the earnings visibility. When you have a lower commodity prices, naturally you see a lower inflation. However, because of the couple of months when we had seen the US Iran war, and the prices of commodities have taken off the roof. Of course, there is a natural phenomenon tendency of the inflation coming through across a couple of months from then, because of these quarter which has gone by. I think FIIs will be back. Government has taken certain interventions in the as compared to reduction in the or removal of the capital gain in some of the debt bonds portfolios, both on the on the short term and long term. So I think that will give support to the fixed income investors on the FII side is concerned. As far as the equity is concerned, still it is too early to say what is going to happen as far as the flow of the FI, but quite positive and quite significantly it is improving over the next every day is we are seeing positive inflows as far as the FI is concerned, and I think we will see that momentum going continuing forward in as we move. At the same time, we are also looking at a very steady flow of domestic liquidity. As I said, domestic SIPs, retail SIPs, mutual fund flows are quite resilient, and valuations are currently conducive. As I said, we were seeing very high amount of overall price to earning, price to book value, valuation multiples were pretty much higher as compared to our peers across Asian markets, across developed markets. So I think that is something which is significantly lower as compared to what it were couple of months and quarters back. So I think that is giving a lot of significant sign of improvement in the valuations. I think the valuation premium has gone down significantly, which means that it is a very good time for not only a domestic investor, international investor, a retail investor to stay invested and come to the Indian markets, because you have of course the inflationary conditions are quite conducive. B, you have valuations which are pretty comfortable at this point in time. C, you have a good strong liquidity, government push across various incentive scheme across various industries. There is a very good amount of flow as we speak, from a domestic institution investors is concerned, retail investors is concerned. We are expecting as we speak, corporate earnings growth of about 12% going forward, which is broad earnings growth of about 12% from India Inc. So I think that is something which is giving a very comforting feeling, given the inflationary conditions, given the conditions on the bond yields, which I think have over the last few days we have seen post government intervention, post a lot of schemes that the government has launched for NRIs, post the schemes that the government have launched for the FIIs on the bonds. I think we have seen money coming in India, and I think rupee becoming a little more stable as compared to what it was a couple of months back. So I think we are still looking at a stable rupee, which is giving a lot of comfort to not only the domestic retail investors but also to the institutional investors and the FIIs to come at this point in time. So I think that is what the future outlook is. It will take time for the market to kind of bounce back in a significant way, but every day, every small step is a very important milestone which we should actually cherish and we should enjoy. And I think one has to take it at a stride, because equity market does not move in a single direction. There is sine wave. It moves in a sine wave. It moves a lot of turbulence is there. I think that is what an investor once needs to understand. One market mantra or one investment mantra for today is stay a long-term investor. I think if you are a long-term investor, the most important thing is to stay invested, and time in the market beats timing the market.